inefficiency nobody could afford anymore.
Treasury Secretary William McAdoo, a determined and forceful figure, takes the lead. He insists on one national express system to support the war effort without duplication or delay. By May, agreement arrives. American Railway Express takes over. Wells Fargo surrenders its routes, equipment, and operations. The era of Wells Fargo as an express giant closes forever. The stagecoach fades into memory. Offices empty. Routes belong to the new agency. Wells Fargo now survives only as a bank. The early 1920s roar with energy in America. World War I ends in 1918. Soldiers return home. Factories switch from war to peace. The stock market climbs month after month. Banking explodes across the country. Branches open in every town. Mergers create larger institutions. Wells Fargo emerges from the war changed. The express business is gone. Nationalization strips away routes and identity. The bank stands alone in San Francisco. Frederick L. Lippman rose from the ranks inside Wells Fargo. Lippman inherits a bank scarred by the 1907 panic. He realizes Wells Fargo needs more capital to weather these storms without risking overextension, and he soon finds a solution. Founded in 1893 by Isaiah W. Hellman, Union Trust Bank was one of San Francisco's oldest trust institutions. It holds deep capital reserves. It specializes in estates, investments, and secure management for families and businesses.
Consolidation of the Wells Fargo Nevada National Bank and the Union Trust Company of San Francisco has been effected, according to the San Francisco Chronicle today.
On March 31st, Wells Fargo Nevada National Bank and Union Trust combine. The new entity becomes Wells Fargo Bank and Union Trust Company. The late 1920s unfold as a golden, breathless time in America. The stock market climbs higher every day, fueled by speculation and easy credit that draws ordinary people into the game of buying shares on borrowed money. Then, October 1929 crashes down. The stock market collapses.
In the 3 months ended on November 30th, the value of listed securities in the United States underwent a greater depreciation than in any similar period in the nation's history.
Frederick L. Lippman holds the presidency through the crisis. He keeps the bank highly liquid. Reserves stay strong. Wells Fargo stands as a rock amid the wreckage. But a powerful rival rises in the West, Bank of America. It began as Bank of Italy in 1904, founded by Italian immigrant A.P. Giannini. He serves small businesses, immigrants, and working people. Branches spread everywhere. Giannini makes banking simple and welcoming. He wins fierce loyalty. By the 1930s, Bank of America dominated California. Branches number in the hundreds. In the 1950s, I.W. Hellman III takes the helm. His grandfather, Isaiah W. Hellman, helped shape Wells Fargo in the early days. His father guided the Union Trust merger. To compete with Bank of America, he knows he has to do something drastic. The 1950s explode with consumerism in America. World War II ends. Soldiers return home. Families move to suburbs. Cars fill driveways. Women enter the workforce in greater numbers. The economy booms. CEO I.W. Hellman III sees Bank of America dominating California with branches on every corner, and he knows Wells Fargo must respond. He pushes hard for retail banking. Everyday accounts, more branches, more loans for ordinary people.
When a company is that big, you don't have the time to deal with the risk of building something organically. So the obvious step is to grow through acquisitions.
But Hellman envisions something bolder, and he lays his eyes on an impossible target. American Trust begins in 1854 as a solid San Francisco bank. It focuses on both commercial and retail accounts. It grows steadily over the decades. By the 1950s, it holds 102 branches across California. It serves consumers, small businesses, and families.
Here's the thing. Wells Fargo was this focused commercial bank, not big in retail branches back then. Yet they swallowed American Trust, a bigger retail outfit with 102 branches. It was a bold move that flipped the script and turned them into California's second largest bank.
Growth continues steadily through the 1960s and 1970s. The bank stays solid. By the end of the 1970s, Wells Fargo has assets of around $11 to $15 billion, ranks as one of the top 20 to 30 U.S. banks, and holds a strong second-place position in California with hundreds of branches. But what happens next will put everything in jeopardy. The late 1970s and early 1980s bring a restless energy to American banking. Inflation squeezes families and businesses alike. Deregulation opens new doors and new dangers. Banks compete fiercely for deposits and loans. Wells Fargo grows steadily through these years, but pressure builds quietly inside. Employees feel the strain of rising quotas. Management pushes for more business. The surface looks calm. Beneath it, something is about to break. It is late 1978 in Beverly Hills. Lloyd Benjamin Ben Lewis, the operations manager at Wells Fargo's Beverly Drive branch, is a trusted insider. He has worked there for years, handling accounts with precision. A friend introduces him to Harold J. Smith, the flashy boxing promoter running Muhammad Ali Professional Sports Inc. Smith is staging big fights, but desperately needs cash to cover costs and impress investors. He even pays Ali a fee to license his name, though Ali stays hands-off. He starts small, concealing Smith's bad checks to keep accounts open. The risk feels low. The rewards feel huge. Over 2 years, he escalates, creating phony debit and credit receipts, manipulating 13 Beverly Hills accounts and 1 in Santa Monica. Money flows to fake companies tied to Smith's promotions. Lewis pockets over $300,000 in kickbacks. The fraud totals $21.3 million. No one notices. Routine checks miss it entirely. Then, on January 23, 1981, a routine audit uncovers discrepancies.
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams, whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
The $21.3 million loss stuns the industry. It ranks as the largest bank embezzlements in U.S. history at the time.
The Wells Fargo National Bank, which is charged that a group of sports promoters stole $21.3 million from its Beverly Hills branch, refused today to discuss details of the alleged theft and said that it had sealed court documents detailing the purported fraud.
At the time, the CEO of Wells Fargo is Richard Cooley. The scandal humiliates him publicly. Cooley orders immediate changes. Mandatory 2-week vacations begin for all employees. Fraudsters can no longer hide behind constant presence. The bank tightens controls across every branch.
That 1981 embezzlement was a wake-up call. A single employee siphoned $21.3 million over years. Huge for the time.
But soon, another disaster waits. Except this time, it will give Wells Fargo the perfect opportunity to repair their image. In the early 1980s, Wells Fargo was growing fast. After Richard Cooley's abrupt resignation in late 1982, Carl Reichardt becomes the new CEO. He grew up in Houston, Texas, earned his BA in economics from USC in 1956. and built his career in banking at Union Bank in Los Angeles under Harry Volk. As a new CEO, he plans to slash costs, close branches, cut thousands of jobs, and refocus on California retail banking to take Wells Fargo to the next level. But little does he know, Wells Fargo will soon face a crisis unlike any of his predecessors experienced. September 12, 1983. At the West Hartford, Connecticut depot, guard Victor Manuel Garena made his move. He is a Puerto Rican separatist with Los Macheteros. He drugged 2 co-workers with chloroform. He bound them with duct tape. Garena loaded $7.2 million into bags. He drove off in a stolen Buick. The heist was the largest cash robbery in U.S. history.
A Puerto Rican terrorist group has claimed responsibility for last year's $7 million robbery from the Wells Fargo Armored Service Corporation in West Hartford, Connecticut.
That White Eagle heist was shocking. $7.2 million just gone in one night. It goes to show how an inside man could exploit trust.
For CEO Carl Reichert, it is a huge blow as the firm is trying to recover from the embezzlement scandal. He pledged total cooperation with the FBI, handing over every scrap of depot footage and employee records. Agents launched a massive manhunt, raiding safe houses across Puerto Rico and the U.S. mainland. In 1985, 17 Macheteros members were arrested in Hartford. Segarra Palmer got 55 years. Others, like Norman Ramirez Talavera, faced trial. Garena fled to Cuba.
What started out as a disaster turned out to be a huge win for Wells Fargo's PR, just like how Wells Fargo started out a century ago. They will hunt down anyone who steals their money.
As the new CEO, Reichert moves quickly. He launches a fierce cost-cutting campaign. Over 100 branches close, thousands of jobs disappear, international operations shrink, the focus turns inward, back to core California markets. The competition only grows fiercer. Reichert sees the math clearly. Efficiency alone won't save them. Scale is the answer. The industry is consolidating rapidly, and organic growth moves too slowly to keep pace. Now he just needs to find a bank to acquire, and he knows just where to look. Crocker National Bank is one of the prominent banks in California. Founded in 1870 by Charles Crocker, one of the Big Four railroad barons who drove the construction of the Central Pacific Railroad. Crocker grows into a powerful Southern California institution. It has hundreds of branches and good connections with wealthy customers and businesses in the growing state economy. But the bank runs into serious trouble. It loses a lot of money on bad loans it gave to countries in Latin America during the debt crisis of the early 1980s. The British company Midland Bank, which bought Crocker earlier, now sees it as a problem because it reduces profits. In the 1980s, with fewer rules on banking, Crocker becomes an easy target for someone to buy.
Wells Fargo and Company said today that it would buy the Crocker National Corporation for about $1.08 billion, creating the nation's 10th largest bank, with assets of more than $40 billion.
Reichert seizes the moment. Midland, eager to divest, accepts Wells Fargo's $1.1 billion offer. A bargain priced at only 1.3 times book value in an industry where premiums often run much higher. The acquisition of Crocker National Bank transforms Wells Fargo overnight. The merger nearly doubles the bank's size, pushing its assets well past $50 billion and expanding its branch network from a modest presence to hundreds more across Southern California.
These days, even banks like Wells Fargo run on automation and AI. As a YouTuber, I'm using the same tools to run my business. Recently, I was building a landing page for my YouTube training program. Normally, that means outlining the page, thinking through structure, writing copy, moving blocks around, and then spending way too much time tweaking details. This time, I used Cintra.ai, which is the sponsor of today's video. So I told one of their AI agents, Connett, what I wanted, a simple landing page. and it just built it. Layout, structure, copy, sections, and debugging, all done in under 10 minutes. So I had a working website I could actually use. What I like about Sintra is that it's not one single chatbot pretending to do everything. You get over a dozen specialized AI helpers, copywriting, business development, SEO, social media, even customer support, all in one platform. You're not prompting endlessly. You're choosing a role and letting it execute. If you want to use the same AI tools I'm using to build and run my business, go to Sintra.ai/Phineas and use code Phineas for a limited time 72% off all plans. That's Sintra.ai/Phineas, code Phineas. Build, grow, and scale your business with a team of AI employees from Sintra.
The early 1990s bring a time of big changes to American banking and the wider economy. Banks start merging at a fast pace to get bigger, cut costs, and compete better. Wall Street cheers the trend because larger banks promise higher profits and more market power. After the successful Crocker merger in 1986, Wells Fargo keeps growing stronger under Carl Reichart's tough leadership. Reichart retires at the end of 1994. Paul Hazen, who has worked closely with Reichart for years and helped plan the Crocker deal, steps up as chairman and CEO.
Paul Hazen had been Reichart's right hand for over a decade, always thinking 3 moves ahead while everyone else reacted. When he took the top job in '94, he had this hunger to make Wells Fargo untouchable.
The industry surges forward in a frenzy of consolidation. Rivals swell larger every month. Hazen knows Wells Fargo cannot stand still. To keep its momentum, to claim new territories and new customers, the bank must expand aggressively. Now, he just needs an opportunity. First Interstate Bancorp stands as one of the biggest banking companies in the mid-1990s. It started in 1958 as a spin-off from Transamerica Corporation. By the 1990s, it ranks as the nation's 8th largest bank holding company. Headquartered in Los Angeles, it operates hundreds of branches across 13 Western and Sun Belt states. Its main business focuses on retail banking, commercial loans, mortgages, and other services for individuals and businesses. But in the early 1990s, First Interstate struggled with bad real estate loans during California's recession. Despite strong management, the bank soon becomes target of takeovers, and Wells Fargo is among them. Hazen knows First Interstate will never sell willingly. The only option left is a hostile takeover. In October 1995, he launches a bid starting at about $10.8 billion in stock. First Interstate fights back at first, seeking other partners as white knights. But Hazen doubles down, rising the bid to $11.6 billion. And First Interstate finally gives in.
Bowing to what appeared to be insurmountable financial pressure, First Interstate Bancorporation said yesterday that it was now negotiating to sell itself to Wells Fargo and Company.
With First Interstate under its belt, Wells Fargo nearly doubles in size, surging from roughly $50 to $60 billion in assets to about $108 to $116 billion, with a much broader network across 13 Western and Sun Belt states. The botched acquisition of First Interstate in 1996 creates a major trouble for Wells Fargo.
It was pure hubris. They tried to do everything overnight. The computers crashed. At the same time, they fired the friendly staff that customers actually liked. What started as a bold move to grow ended up hurting the bank's reputation, profits, and customer trust.
The Wells Fargo First Interstate merger showed how quickly a failed integration can ruin even a strong bank. Seeking size doesn't always win in banking. People chased merger trend without thinking about the real costs. The cultural clashes, system failures, and lost customers. It was a classic example of smart executives making dumb mistakes by following the trend.
Paul Hazen faces heavy criticism for the failed integration. As CEO, he takes much of the blame for rushing the process and not planning carefully enough. But he still hopes Maybe another acquisition will help solve Wells Fargo's problem. But this time, he needs a savior. Norwest Corporation, based in Minneapolis, stands out as a strong and growing bank in the late 1990s. Founded in 1929, it builds a solid business model focused on retail banking and customer relationships. Under CEO Richard Kovacevic, who takes the top job in 1993, Norwest emphasizes cross-selling, getting customers to use multiple products like mortgages, loans, insurance, and investments. When Wells Fargo struggles after the first interstate mess, its stock price drops and it becomes vulnerable. For Richard Kovacevic, this may just be the opportunity to take over a bank and take his cross-selling strategy even further.
The Norwest Corporation and Wells Fargo and Company agreed to merge yesterday in a $34 billion deal, the latest in a string of blockbuster unions that have created a clear cadre of giants.
The two companies announced a merger of equals in 1998, valued at about $34 billion. But truly, it was a takeover by Norwest. Norwest is the legal survivor, but the combined bank keeps the more famous Wells Fargo name and moves headquarters to San Francisco.
The Norwest-Wells Fargo merger was full of irony. Norwest, the smaller but more successful player, effectively took over the historic Wells Fargo, yet the famous Stagecoach name survived while Norwest's identity faded.
Wells Fargo went from being the aggressive acquirer to the one being acquired. This deal completely changed Wells Fargo's direction and culture. It goes to show how quickly fortunes can flip in banking. Yesterday's powerhouse can become tomorrow's takeover target.
In the mid-2000s, low interest rates and easy credit fuel a massive housing boom in the United States. Wall Street banks dive deep into the market by packaging risky subprime mortgages into complex securities and selling them to investors worldwide. Wells Fargo also benefits from the housing surge as one of the nation's largest mortgage lenders, originating billions in home loans during this time. But Wells Fargo focuses on traditional lending to customers it knows well, often holding loans on its own books rather than securitizing and offloading them. It avoids the heaviest exposure to the most toxic subprime products that other big banks chase for quick fees.
The nation's fourth largest bank reported a $393 million first quarter loss and has been forced to cut its dividend and seek a $7 billion cash injection to make up for a poorly timed expansion of its mortgage business.
Wachovia, a major East Coast bank headquartered in Charlotte, North Carolina, grew quickly through acquisitions and became the fourth largest bank in the U.S. by assets. But by September 2008, amid the broader financial panic, Wachovia suffers a silent run on deposits and stands on the edge of collapse. CEO John Stumpf at Wells Fargo sees an opportunity to expand eastward. He enters a fierce bidding war with Citigroup, which initially brokers a government-backed deal to take over Wachovia's banking operations for about $2.2 billion with FDIC loss-sharing support. Stumpf pushes hard, offering a no-assistance, all-stock bid that values Wachovia higher and keeps the company intact. Stumpf wins the battle in October 2008 when Wachovia accepts Wells Fargo's $15.1 billion all-stock offer after Citigroup's deal falls apart. The merger closes in December 2008, making Wells Fargo the country's fourth largest bank by assets and creating a coast-to-coast presence. Wells Fargo soon discovers Wachovia holds about $100 billion in toxic assets. These bad loans lead to huge write-downs and losses in the following years, straining the bank's capital. After the 2008 crisis, Wells Fargo and other major banks received government support through programs like TARP to stabilize their balance sheets and manage toxic assets. CEO John Stumpf, determined to boost performance and regain momentum, doubles down on cross-selling, pushing employees to sell more products per customer. He sees it as the key to higher profits and customer loyalty. Little does he know, this intense focus on sales will backfire, as Wells Fargo is about to suffer the worst catastrophe in its recent history. In the mid-2000s, under CEO John Stumpf, who took over in 2007, the bank built its success on a strong cross-selling model inherited from Norwest, aiming to sell multiple products like checking accounts, credit cards, loans, and insurance to every customer.
There was the slogan called 8 is great. It really was about the goal of averaging 8 products per household, which helped drive profits and earn praise from Wall Street.
This created a high-stress environment where meeting targets became the top priority over customer needs. Many employees felt trapped between losing their jobs or bending rules to hit goals.
Claudia Ponce de Leon is a branch manager in Pomona, California. In early 2011, facing relentless quotas, she begins to see employees opening unauthorized checking and savings accounts for customers without their knowledge, sometimes transferring $25 from real accounts to fund them and meet daily goals. In one instance, a banker forged a customer's signature on an application and issued a debit card with a simple PIN like 0000 to activate the fake account, avoiding detection. Ponce de Leon called the ethics hotline in January 2011 to report the fraud, but instead of action, she was fired 3 weeks later.
Back in 2013, I walked into a Wells Fargo branch to open a business account. The employee started my paperwork, but stepped away for 3 minutes. Another banker swooped in, pulled me to her office, and started setting up the account for me. The first guy stormed back, lashing out at her passive-aggressively for stealing his client. I thought, damn, these employees were cutthroat and competitive.
This pattern echoes elsewhere. Colin in San Diego, a Colorado manager in mid-2010, enrolls homeless individuals off the street to pad quotas. What begins as isolated survival tactics spreads like a virus by 2011, ensnaring thousands in a web of deceit.
Wells Fargo is being hit with a $190 million fine for creating fake customer accounts that regulators say were illegal.
The scandal first gained real attention in late 2013 when the Los Angeles Times published an investigation exposing intense pressure on bankers and managers to meet aggressive, sometimes impossible quotas. The article detailed how employees opened unauthorized accounts to hit goals and earn bonuses, quoting workers who described the culture as a pressure cooker. By September 2016, the Office of the Comptroller of the Currency and the City of Los Angeles fined Wells Fargo $185 million for creating about 1.5 million unauthorized deposit accounts and over 500,000 credit cards between 2011 and 2015. The bank also refunded $2.6 million in fees to affected customers and admitted firing more than 5,300 employees involved in the fraud.
The fake accounts scandal stemmed from a toxic sales culture where cross-selling quotas were treated as sacred even when they were unrealistic. It happened because leadership prioritized short-term metrics over ethics. It created an environment where cheating became the path to survival. The scale, millions of accounts, showed how deeply the problem was embedded.
The fake account scandal explodes in 2016 and brings heavy consequences for Wells Fargo. By late 2016, the company's market value falls by billions and profits suffer as regulators watch every move.
Wells Fargo is making changes to make things right.
Tonight, Wells Fargo doing damage control once again, refunding customers for monthly add-on charges applied without their full permission or understanding.
CEO John Stumpf tries to calm the storm by apologizing publicly, promising changes, and saying the bank will fix its sales practices.
What I said yesterday is that John Stumpf will be out by the end of the year, and he is indeed out by the end of the year.
Stumpf steps down as chairman and CEO, and the board forces him to give up $41 million in stock awards as punishment.
John Stumpf's resignation felt ironic. He had been the face of Wells Fargo's success, turning it into a profitable giant through cross-selling. But the same aggressive strategy he championed led to the fraud that destroyed trust. His downfall showed how quickly a leader's greatest strength can become his biggest weakness.
In February 2018, Federal Reserve Chair Janet Yellen imposes an unprecedented growth cap on Wells Fargo.
Welcome back. The shackles on Wells Fargo. The Federal Reserve has slapped Wells Fargo with an unprecedented punishment for years of misconduct, including the creation of millions of fake user accounts. The punishments imposed on Janet Yellen's last day as chairman of the Fed will restrict growth at Wells to under $2 trillion in assets, pressure the removal of 4 Wells Fargo board members, and require the submission of detailed plans to remedy Wells Fargo's wrongdoing.
The cap was a rare punishment meant to force real change. When the news hit, Wells Fargo's stock almost collapsed. Investors worry that the bank may never be able to compete again.
After Stumpf leaves, Tim Sloan, a longtime insider who had been chief operating officer, becomes CEO in October 2016. He promises to rebuild trust by changing sales practices, improving risk management, and working closely with regulators. But the problem is so deep that he resigns after less than 3 years because he simply can't fix the rotting core of Wells Fargo. In 2019, the bank keeps losing ground to competitors, and its reputation remains damaged. Without a major turnaround, it will be dead or getting swallowed by lesser banks. Someone must step in to save it, and that person will have to come from outside the company. Charlie Scharf is a seasoned banker with a reputation for being a turnaround guy. Growing up in Westfield, New Jersey, Scharf experiences a stable suburban life where his father's job as a stockbroker introduces him to the world of investments. Starting at age 13, he takes summer jobs in Manhattan brokerages, handling back-office tasks like data entry and working in vaults, which teach him the basics of hard work and attention to detail. After graduating from Johns Hopkins University, Scharf joins commercial credit in 1987 as an assistant to Jamie Dimon, who quickly becomes his mentor during aggressive expansion efforts under Sandy Weill. He follows Dimon through major deals, including the acquisition of Primerica and the creation of Citigroup in 1998, where he rises to CFO of Salomon Smith Barney at just 30 years old.
He was an extremely loyal person. When Dimon was fired and had to go to Bank One in Chicago, Scharf went there too, becoming CFO and later CEO of its retail division, and his style is very similar to Jamie Dimon's.
By 2017, Scharf serves as CEO and chairman of BNY Mellon, where he streamlines operations in custody banking and asset management for global clients. After a track record of successful turnarounds, he catches the attention of Wells Fargo's board amid ongoing fallout from the fake accounts scandal and the Federal Reserve's asset cap. For them, Scharf may just be the one to save the bank from extinction. Charlie Scharf takes over as CEO of Wells Fargo in October 2019.
So the new Wells Fargo CEO will be Charlie Scharf, who of course is currently the chairman and CEO of Bank of New York Mellon. This breaking just moments ago. He will be CEO and president. He'll be a member of the board at Wells Fargo.
It will be one of the toughest jobs in banking after the fake accounts scandal shattered trust and triggered massive fines. He faces a broken culture from aggressive sales pressures, ongoing regulatory scrutiny, and a strict Federal Reserve asset cap of $1.95 trillion that limits growth.
The bank struggled with outdated risk controls, compliance failures, and low employee morale. Many wonder if the 170-year-old institution could recover at all.
Scharf launches sweeping changes to address the root causes of the scandal and restore stability. He brings in new leadership from outside and fires 55,000 people. It's one of the biggest cleanups ever. He exited unprofitable areas like parts of mortgage servicing and invests heavily in risk management with thousands of new professionals and advanced monitoring tools. He overhauls performance reviews to emphasize ethics over sales quotas and simplifies operations to reduce complexity.
You can clearly see Jamie Dimon's influence on him. Scharf's approach was methodical and uncompromising. He focused on fixing the basics, risks, controls, and culture before chasing growth and profit.
After several years of consistent effort, the Federal Reserve lifts Wells Fargo's the asset cap on June 3rd, 2025.
This was imposed all the way back when Janet Yellen was still the Fed chair, if I believe, right? That's correct?
Correct.
7 years, the idea that this asset cap basically meant your balance sheet can't go above this amount, which basically means you effectively can't grow. If you're a bank, you basically can't grow.
This milestone ends 7 years of strict limitations on the bank's growth. Wells Fargo resolves multiple regulatory consent orders and strengthens its financial performance. By 2025, the bank's total assets surpass $2 trillion for the first time, marking significant balance sheet growth.
Shares up about 3.3% in pre-market trading. The company did raise its medium-term target for return on tangible common equity to 17 to 18%. I believe that's why the shares are reacting so favorably.
Charlie Scharf's leadership transforms the bank from a constrained institution into one ready for expansion. Today, Wells Fargo stands in a solid position to pursue organic growth and serve customers more effectively.
The story of Wells Fargo really is the story of America. It began as a frontier lifeline during the gold rush and grew into a banking giant that mirrored the nation's expansion and ambition. Through mergers, scandals, and recoveries, the bank has shown the same resilience and reinvention that define American enterprise. Under Charlie Scharf, it has once again proven that even after deep wounds, an institution can rebuild trust and reclaim its place in the economy.
However, success doesn't last forever. In today's fast-moving, interconnected financial world, a single serious misstep could quickly unravel even the biggest bank in America.
Capfin is the people for the people who need a personal loan top-up. Yes, sir. You didn't hear it from us. Here's a bit of what Azwimbabi wrote. I'm happy so far with the service, and they even top up your loan after successful repayments. Apply online and see why we have given Mzansi over 12.5 million loans. Capfin is a registered credit provider. T's and C's apply. Plan smart. Think Capfin.
It's the company that dictates how money flows around the world. For nearly 8 decades, Visa has dominated the market, virtually unchallenged.
Top dogs in finance used to be big banks with trillion-dollar balance sheets. No longer. Earlier this month, Visa, a humble payments processor, became the world's most valuable financial services company.
In 2023, Visa processed an impressive $14.8 trillion in total transaction volume over the previous 12 months.
By ruthlessly crushing its competition, Visa has managed to become the king of credit cards. In 1928, Amedeo Giannini is the most powerful banker on the West Coast. His bank has recently just achieved an impossible milestone, having $1 billion worth of assets. Bank of America.
On the East Coast, you have banks like JP Morgan, Citibank, and Chase Bank in close competition.
But on the West Coast, Bank of America was the dominant force in a growing market, thanks partly to the unprecedented immigration to California. Giannini now has the money and the power. It is a stark contrast to the humble beginnings from which he clawed his way to the top. Born into an Italian immigrant family, Amedeo Giannini manages to build a successful career as a grocery merchant. He knows his success is meaningless unless he can also help out his own people, the Italian immigrants.
He was the son of humble origins of this first wave of immigration. Giannini's uniqueness was to be able to understand that Italian immigrants were discriminated against and despised. He therefore stood by them to grow both the Italian-American community and all of California. He was one of the first bankers to lend money to middle class and immigrants.
Before long, Giannini grasps a pivotal truth. Launching his own bank would allow him to lend even more money to his people with greater impact. In 1904, he establishes the Bank of Italy in San Francisco. His hard work and generosity towards the working class people become the cornerstone of his burgeoning success.
His bank was a completely different bank from any other, based on absolute generosity. But above all, on a new vision developed by staying in touch with ordinary people.
Giannini seizes the perfect moment as California surges into its most unprecedented growth era. As California's economy explodes, Giannini's bank becomes a huge success. By the late 1920s, his bank boasts over $1 billion in assets, and through a series of mergers, it acquires a new name, Bank of America.
From the very beginning, Giannini had a singular vision. He wanted Bank of America to become a financial supermarket that offers all kinds of services to the masses. This meant not just traditional banking services like savings and checking account, but also extending into other areas like mortgage lending, auto loans, insurance, and investment services.
By offering loans to the burgeoning middle-class consumers, the bank's business flourishes exponentially. In the following decade, Bank of America's assets soar to over $5 billion, becoming the largest bank in the world. In 1954, S. Clark Baez is elected president of Bank of America. Long before this moment, Baez has been a dedicated manager, working side by side with Giannini to forge the empire of Bank of America.
In the mid-1950s, the bank was one of the largest in the United States, expanding its services and branches nationwide. So as the leader of Bank of America, S. Clark Baez was a very pragmatic and forward-thinking individual.
For Baez, the shadow of his predecessors, especially Giannini, looms large, and he is determined to create a legacy to call his own. Tech-savvy, Baez begins to explore the possibility of a new type of business as the country witnesses one of its biggest economic booms.
Weekend Nkulu is here. Stand a chance to win 15,000 Rand. Enter online and rent a smartphone with PhoneYam and make your long weekend happen. 10 weekly winners. Apply online at phoneyam.co.za. Everything good becomes AM with PhoneYam.
The 1950s in the United States is a decade of post-war prosperity. It's a time when the middle class flourishes, enjoying higher earnings and increased spending power thanks to rising wages and widespread employment. Consumerism is on the rise, fueled by a booming housing market and the widespread availability of new consumer goods like automobiles and household appliances.
Around this time, we saw a huge spike of consumer credit. What does that mean? Consumers could buy goods and services without having to pay in advance.
Gas stations introduced gasoline cards, allowing customers to fuel up on credit, and airlines offer their cards to facilitate travel on credit while fostering loyalty. General stores like Sears also issue these cards for purchases in their retail stores. These store cards empower customers to buy goods on credit. As the new chief executive at Bank of America, S. Clark Buys aims to build a new business for the bank. And one of his managers has the exact plan to realize this vision. Joseph Williams was born in Newark, New Jersey, attended the University of Pennsylvania, and served as an infantry officer in the U.S. Army during World War II. After the war, Williams looked for an industry that was growing, and he soon became an employee at Bank of America. As he witnesses the rise of various special purpose cards, Williams sees a need to create a single general purpose card to replace all of them.
The value of a single card that could replace all those other forms of credit would be so instantly obvious. He was among its growing core of middle managers.
Prior to the introduction of credit cards, securing a personal loan required a meeting with a loan officer. This method was very time-consuming.
But William has a bold idea. He envisions a card that contains a $300 credit and freely given to every Bank of America customer.
The idea of a 1-month grace period, a time during which customers could pay off their balances without facing interest charges, emerged from that research, as did the idea of charging 18% a year on credit card loans, a figure that would be seemingly set in stone for the next 30 years, even as every other manner of interest rate fluctuated wildly.
If this form of credit card works, Bank of America will be able to charge high interest rates, and it has the potential to become a highly profitable business. And it will also catapult Williams to the pinnacle of the corporate ladder at Bank of America. In September 1958, Bank of America initiates what they call Fresno Drop. It is an unprecedented mass mailing campaign.
This was one of the craziest events in banking. It picked a city in California, Fresno, with 250,000 people, and give each of them a credit card called Bank of America card.
Approximately 60,000 unsolicited Bank of America credit cards find their way into nearly every household in the city. This audacious move essentially provides a line of credit without prior applications or approvals for the very first time in the history of banking. The card comes with a $300 credit limit, a 1-month grace period, and an 18% annual interest rate. It's a card for every need, usable for various purchases at multiple merchants.
Williams and his group saw that a credit card could be used in 2 ways. It could be used either as a device offering convenience, as a Diners Club card did, or as a device generating an instant personal loan.
With credit cards seemingly materializing from thin air, customers are eager to spend this, what appears to be free money. During the first few weeks, the project seems like a success. Bank of America immediately drops more credit cards to other cities in California, aiming to dominate the market before competitors can catch up. Before launching Bank America Card, the bank's typical customers had a delinquency rate of about 4%. Williams used that as an assumption for the new credit card holders. But what he doesn't know is that the actual delinquency rate skyrockets to a staggering 20%, with nearly 1 in 5 customers failing to repay their credit card loans by month's end. Customers and merchants quickly learn to exploit the system, forging signatures and reporting fake transactions. In a short span, Bank of America finds itself hemorrhaging $8.8 million, an amount scandalous for any bank in the late 1950s. As a result, Joseph Williams is fired.
Williams was a tragic figure. He had the right idea, but his execution didn't match up.
The initial launch of Bank America Card was a disaster. To recoup losses, the bank begins retracting cards from delinquent customers and enlists collection agencies to pursue outstanding debts and interests.
Despite First No Drop's marketing fiasco, it inadvertently proves a compelling thesis that the majority of people do desire a credit card.
A year after launch, Bank Americard slowly begins to recoup its losses, transforming into a profitable enterprise. But the bank soon discovers a revolutionary new way to make money from the credit card. By the mid-1960s, Bank Americard continues to generate profit. It begins to catch the attention of other banks. To many of its competitors, they realize that they are too late to the game because they don't have the resources to build their own credit card issuing and payment processing system. And after the retirement of S. Clark Bice, the new man at the helm, Rudolph A. Peterson, is determined to take advantage of this situation. He quickly sees this as an opportunity for a new type of business income. He realizes that Bank of America could let other banks issue their own credit cards by allowing them to use Bank of America's well-built infrastructure for a fee.
Licensing means letting other banks use Bank of Americard's system.
In the early 1960s, Bank of America begins to allow licensing for other banks to issue cards under the Bank Americard program. This means that these banks can issue credit cards using the Bank Americard name and, more importantly, let Bank of America handle the transactions, while these banks focus on providing the loans. This licensing model proves to be a resounding success. Within a few years, Bank Americard evolves into one of the most profitable entities in the industry. But as more banks adopt and issue their credits using Bank Americards, a different kind of problem comes to the surface. Following Bank Americard's launch and explosive popularity, criminals quickly identify a unique opportunity. Instead of robbing the bank outright, criminals break into warehouses and steal Bank Americards that are not yet sent to customers.
At the time, the infrastructure for tracking and canceling individual cards was not very efficient as it is now today. The stolen cards were unembossed, meaning that they had not been assigned to specific account holders yet.
These criminals then attempt to sell the stolen cards back to the bank, putting the bank in a difficult position. Credit card theft is a new type of crime. The bank fears that the unauthorized use of stolen credit cards would cost them more than paying the ransom, so they decide to repurchase the cards from the criminals to prevent further misuse. Yet fraud is merely a tip of the iceberg in the myriad of issues faced by Bank Americard and its licensing banks.
Because the vast majority of credit card transactions involve two separate banks. With every transaction, the merchant bank would reimburse the store for every credit card sale it made. Then the merchant bank would send out the sales drafts to the member banks around the country whose customers had made those purchases. The customers' banks, in turn, would reimburse the merchant bank, taking a fractional amount of the transaction for itself, the interchange fee. Finally, the customer's bank would bill the customer for the item. When the customer paid, the transaction was complete.
As transactions continue to surge, the system nears a critical breaking point. If Bank Americard can't find an efficient way to scale, the entire business could crumble. To address this crisis, a man from an unlikely place steps forward with a solution that could change everything. The man most capable of solving Bank Americard's problem hails from the most improbable origin imaginable: Utah, the Mormon state of America. Growing up on a farm, D. Hawk's childhood is marked by solitude and the love of nature. As a Mormon, D. Hawk develops a lifelong habit of early mornings and hard work. But he quickly rebels against his faith and his school.
Early on, I never felt I belonged in that family. My father is very tall and physically oriented, and I was somewhat introverted and loved to be alone and wander outside in the fields, and I was not close to my father. We were constantly confronting one another. He was of the school that said there's only one way, one right way to do everything, and of course, that was his way, and I always resented him.
He frequently gets into trouble, despising classes and preferring the solitude of nature and self-directed studies.
D-Hawk did not like following rules at all. He's the type that would change the world around him rather than changing himself.
As a result, after college, D-Hawk struggles to hold on to jobs. Despite being a high performer, D-Hawk despises office structure and often clashes with his superiors, leading to his terminations. By the early 1960s, with a pregnant wife, Hawk faces the humbling reality of seeking unemployment support from the government.
I had no money in the bank, no friends, no family, just my wife Pearl and I, and our 2 children, with the other one on the way. I was out of work and had no idea what to do. I was having a bout of depression. The first thing that occurred to us, we were without income, and I had these 3 people to support that I should go and apply for unemployment. So I drove to the unemployment office. Across the street from it, there was a line of people waiting to get in because it was a time of mild recession, and I simply could not get out of the car. I sat there for well over an hour and a half trying to persuade myself that I was entitled for unemployment compensation, but I just couldn't do it. I felt that it was contrary to everything I believed in and the work ethic I had acquired. And I had a feeling that if I ever got out of the car and got in that line, something inside me would simply die. After an hour and a half of torment, I had to drive home and explain to a 7-month pregnant wife that I couldn't do it.
D-Hawk is determined he will do whatever it takes to succeed and to never let this happen again.
It's pretty easy sometimes to feel beaten when you're faced with all those issues and all those problems and they all hit you at the same time. That doesn't mean give up.
He eventually lands an assistant job at the National Bank of Commerce. This time, to provide for his family, he's willing to take on any work necessary. Soon, he's asked to perform a task that yet again goes against his beliefs. It is to help launch a credit card business for his bank.
D-Hawk was a very frugal guy, and he did not like the idea of credit cards at all.
But D-Hawk throws himself into the job, determined to excel. By 1967, through licensing from Bank of America, the National Bank of Commerce successfully launches its credit card program. The business takes off immediately, and D-Hawk quickly earns a promotion to head the credit card operation. By the late 1960s, the credit card industry explodes, fueled by American economic prosperity. As a first mover, Bank of America's Bank AmeriCard becomes the leading credit card. But as the business grows, a flaw in the system becomes apparent.
Frequently people discuss advantages as first mover. It's the first to scale. The first to scale, generally speaking, tends to get the attention from the press, tends to get privileged access to capital, tends to get privileged access to talent.
While Bank of America has managed to reduce fraud, the licensing system makes fraud prevention increasingly difficult.
In the 60s, Bank of America's Bank AmeriCard program let different banks give out their cards. This caused a lot of issues with credit card theft. Back then, technology wasn't advanced enough for a wide-scale fraud detection. So this whole setup made it really tough to deal with fraud issues popping up everywhere.
If Bank AmeriCard doesn't address this issue, competitors could exploit it with better systems. To prevent that, Bank of America needs someone to design a system that ensures its credit cards' continued dominance. As a licensee of Bank AmeriCard, National Bank of Commerce has a vested interest in the system's success. D-Hawk has recently been promoted to the head of the credit card division, and he immediately proposes forming a committee comprised of all member banks to decisively tackle the problems. He is then appointed as the committee's chairman. As the head of the committee, Hawk is armed with a mission to design a revolutionary system, unlike anything corporate America has ever seen. It is an opportunity for Hawk to finally do things his way. He starts by reflecting on his own childhood and the lessons learned from nature.
I saw such a clear distinction, even then, between nature and human beings. Nature never seemed to have this problem. There was no principal black bird in a flock. There was no president tree in the forest, and yet everything was competition and cooperation in nature. The two just seemed constantly blended and coexisting. But when you move people into an organization of any kind and the divisiveness started, it was either this or that. It was either true or it was false. It was right or it was wrong. It was either good or it was bad.
Hawk's ideas are profound. He envisions a self-organizing, self-functioning, and self-governing distributed system.
Wow, he was pretty much envisioning a distributed network system that has no central governing figure, a decentralized network. And each of the nodes must agree to follow a set of principles and algorithms, and as a whole, the system will function optimally.
To fully unleash the power of his design, D. Hawk proposes forming a new organization, independent from Bank of America. He calls it National Bank Americard, Inc.
Remember, credit card networks are merely payment systems. It's the banks that issue credit cards. So NBI was a payment network that by itself does not issue any debt.
While his ideas are innovative, Hawk remains unsure whether other member banks will join, especially his biggest partner, Bank of America.
It was tough in the beginning. These people are being asked to put their reputations on the line and join something that they are totally unfamiliar with. I understand their hesitation.
With the support of Bank of America, D. Hawk becomes president of this new organization. But what Hawk doesn't know is that Bank of America is also secretly working with American Express to build a new system, potentially undermining Hawk's entire effort. For D. Hawk, in order for the Bank Americard system to succeed, he needs to make sure the payment network is as secure as possible. In the digital age, privacy threats are ever present as our lives move increasingly online. This is where NordVPN kicks in. NordVPN helps you protect your data by encrypting it, keeping it safe from potential data miners or breaches when you are surfing on the internet. It is fast, reliable, and easy to use.
For someone who enjoys writing in coffee shops, NordVPN allows me to browse the internet without worrying about losing my data or getting hacked.
Not only does NordVPN help secure your network, it also helps protect your privacy. NordVPN allows you to browse the internet anonymously, protecting your activities from prying eyes with its trusted network of over 5,000 global servers.
One of the most used features is the ability to change locations to anywhere. While visiting China before, I was able to watch my favorite TV show, Succession, using NordVPN.
Just simply change your country. You can kick back, sit, and relax while watching the show you wanted to watch.
To get NordVPN, be sure to use my link, nordvpn.com/Phineas, and receive 4 extra months all for free.
Afraid that the decentralized system proposed by D. Hawk may fail, Bank of America secretly collaborates with American Express to build a nationwide credit card authorization system, controlled solely by them. This revelation comes as a shock to Hawk, especially since Bank of America is a key member of the National Bank Americard, Inc. If Bank of America and American Express succeed with their new system, it could render Hawk's efforts a waste of time and energy.
It's like building 2 competing highways. It's not good for society and a waste of resources.
I felt completely betrayed. It was contrary to the spirit of the effort to form NBI and could materially affect its success. Bank of America had agreed to join the new organization I designed, but I didn't know at all that it was also working with American Express to undermine my effort.
In response to this challenge, Hawk and the NBI board make a bold decision to break away from the industry-wide effort and build their own proprietary competitive system for electronic authorization and transaction clearance, known as the Bank Authorization System, Experimental, Base 1.
Authorization is necessary to check whether a cardholder's credit card holds sufficient funds and is approved to purchase from a merchant.
But what Hawk doesn't realize is that the real threat is not American Express. A new credit system is on the rise, and it is gunning for his business. The mid-1970s present significant economic challenges marked by the oil crisis, high inflation, and economic stagnation, also known as stagflation. In this turbulent period, monetary policies struggle to find a balance between inflation control and economic growth. But amid these difficulties, the credit card industry experiences rapid growth and evolution. This era paves the way for widespread credit card adoption, shaping modern consumer finance and banking practices. The introduction of Base 1 revolutionized transaction processing, propelling NBI to the forefront of the financial services industry, thanks partly to one man, D. Hawk.
The business model really is like a money printing machine. It earns money every time someone uses the network for payments, becoming more popular as more people and shops use it, due to network effects. And on top of that, it's highly scalable because it can easily handle more payments without much effort.
But success breeds competition, and a challenger arises, ready to undo all of D. Hawk's achievements. Witnessing the success of NBI and its member banks, other banks in the industry realize the potential of forming their own credit card network. MasterCharge, later known as MasterCard, emerges from a collaboration of regional bank card associations, aiming to create a unified, competitive force in the burgeoning credit card market. To challenge Bank Americard's dominance, MasterCharge focuses on expanding its network and increasing its acceptance both domestically and internationally. If MasterCharge gains enough momentum, it has the potential to completely overtake Bank Americard as the leading card payment system. Desperate to protect his creation, D. Hawk makes a tough decision. He rolls out an anti-duality policy, prohibiting his member banks from adopting MasterCharge. He hopes that this bylaw will prevent his member banks from adopting MasterCharge. But he has no idea what is about to happen. Worthen Bank of Little Rock, Arkansas is a smaller member of NBI. In late 1971, the NBI board adopted the bylaw against duality for its members. Worthen Bank promptly files a lawsuit, alleging antitrust violations and seeking an injunction to block the bylaw's implementation.
The Worthen Bank of Little Rock, Arkansas had also become a member of MasterCharge. They threatened to sue NBI if it adopted a proposed bylaw prohibiting duality. I flew to Little Rock to meet with the president and other senior officers of the Worthen Bank in an effort to persuade them. But unfortunately, we could not agree. The Worthen Bank promptly filed a lawsuit alleging violation of the antitrust laws and asking for an injunction to prevent enforcement of the bylaw.
To make matters worse, Hawk's decision to forbid its member banks from adopting MasterCharge has an unexpected consequence. It gets personal.
During the Worthen Bank lawsuit, D. Hawk also faced a lot of personal threats. He received a lot of abusive messages, even found a cross slashed on his office chair, and received threatened packages containing a vandalized book from his library.
Each day, I had to rise and deal with countless problems. The business had to go on, and responsibilities could not be shoved aside. I began to slide into depression, that dark, dismal swamp that robs my ability to think or function normally.
In the end, Wortham Bank wins the lawsuit, and D. Hawk is forced to lift his ban. And now, his member banks are free to issue both Bank AmeriCard and MasterCharge cards. Despite the legal challenge, NBI is about to enter one of its highest growing stages ever. Although the 1970s are a troublesome decade for the United States, international travel and trade have risen sharply for the rest of the world, leading to explosive business opportunities for the use of credit cards. By capitalizing on the shift towards a cashless economy and consumer demand for convenience, Bank AmeriCard has become the global leading payment system. But D. Hawk realizes that to further simplify its international business, there needs to be a strong and powerful brand. By the mid-1970s, his firm decides to change the name from Bank AmeriCard to Visa.
The Bank AmeriCard is headed for extinction, at least in name. Starting sometime next year, according to National Bank AmeriCard Inc., the name of this credit card will be changed all over the world to Visa, a word expected to be universally acceptable.
By the early 1980s, despite facing intense competitions, Visa has achieved significant market share of 60%. By introducing products like Visa Traveler's Checks and innovative security features like holograms on cards, its billings soared to $59 billion. As a result, Visa is now one of the most powerful companies in finance. D. Hawk's thesis has been proven correct. He has built Visa into a thriving, decentralized organization. Believing his mission is fulfilled, and to further prove that Visa is a unique entity that can do well without him at the helm, he decides it's time to retire.
D.W. Hawk, President and Chief Executive Officer of Visa International and Visa USA, said yesterday that he would retire next year.
Little does Hawk know that within a mere decade, Visa will grow to become a monster, an industry power that will defy everything he stood for. The credit card industry is on the rise. By the early 1990s, it handles trillions in transactions. Recognizing this lucrative opportunity, many industry titans are eager to capitalize on the trend. One of them is Phil Purcell.
Purcell was very entrepreneurial from the very beginning. Even as a young man, he was already demonstrating his hustle, selling magazines and working at local dry cleaners on school days. He always understands business at a very practical level.
While working at Sears, Purcell spearheads the launch of Discover. It's a credit card aimed at middle-class shoppers.
I don't like that.
The card that actually pays you cash back for every charge.